Hi everyone, I'm Bagger Don at Stock Market Caddy. Today is March 16th at 12:30. We think that we're hitting a very important inflection point in the markets, a very important inflection point. We are not making any specific recommendations to buy or sell anything. We just want to bring your attention to what we are looking at and what we are about and how we go about trading the markets. First thing is about this date, March 16th. The March contract in the futures rolled out in here. So the short squeeze game that was being played in the last few weeks is, for all intents and purposes, over. The banks and everyone is now trading the June contract, in our view, a little bit less likely, less chance of squeezing it. The March contract will be officially dead the 19th, but it's technically dead now, and everyone is trading the June contract. Tomorrow is the Federal Reserve meeting. Friday is triple witching. Now, historically and traditionally, markets have a tendency to run up into the Fed meeting and run up into triple witching or quad witching. They also traditionally have a bias to sell off within a couple of days of either of these meetings, and they're actually, or either of these events, and they're actually occurring within a couple of days of each other. So we think there could be an explosion of volatility in here, and we think that volatility will be to the downside, and I want to explain why. You're looking at what we call the swing machine. And the swing machine is an algorithm meant to pick up on the trends. And we can do and track trends on anything. In this view, we're tracking the trend of the interest rate. This is the 13-week 90-day Treasury paper, this symbol right here, on a daily basis. This is the 5-year. This is the 10-year. This is the 30-year. These are yields. So let me explain to you what the yield is. The yield is not 0.10. You actually need to move the way they, it can be a little confusing, but you actually move the decimal over, and that'll give you the true and current yield on 90-day paper, which is 0.01. 5-year, 0.81. 10-year, 1.6. And 30-year, 2.3. Now, there's a few things that you need to appreciate here before we get to the chart down below. A year ago, the yield, the yield on the 10-year paper was down about 0.55. So the yields on the 10-year have virtually tripled. Now, they're still very low, but the rate of change has been very fast for this market, and very steep. These markets, these treasury markets, are the biggest, deepest, most liquid markets in the world, and many times bigger than the NASDAQ or the Dow or any of the equity markets. So it's a very, very important market. Now, what's interesting to us, and should be to you, is the spread between the 90-day paper and the 10-year. That's what we calculate down here. We subtract this yield from here, and this gives us the steepness. Understanding how banks function. Banks borrow from the Federal Reserve, from each other on a short-term basis, and then loan the money out to the sheeple. They make the spread. So when the spread is wide, the banks are doing well. So this has been a condition that has been going on for a long time. As you can see, the yield on the 90-day has been trending down for at least 42 days. The 10-year has been trending up for 115 and 147. So it's been back here in August, just a steady rise up. So it is no wonder that financials have run. It is no wonder that the markets have run, particularly the small caps that have a heavy concentration in financials. It is no wonder that people are buying non-fungible tokens and whatnot and football cards, because their cash that is sitting in money markets is effectively negative now, because the inflation rate is pushing, admitted by the Fed, close to 2%. So their cash value is just melting away. And the reality of it is inflation is probably much higher, but that's the admitted inflation rate. What happens here? Is the Fed going to allow the 90-day paper to officially get negative? There's all sorts of problems and connotations for that for the banks. And if the banks have a problem, then the market's going to have a problem, particularly the Russell. Now, the Fed could try to orchestrate a soft landing. They own a ton of these treasuries. They could try to twist their position. That is, sell treasuries on the short end of the curve, in effect trying to raise the rate here a little bit, and buy treasuries out here, pushing them down. It'd be a very delicate operation, because if the market begins to realize that we're so steep that it can't get any steeper, you might think of this as a gas pedal on one of those dragsters, and the thing is racing down the track straight away, full bore. How much harder is the Fed going to allow this gas pedal to stay pedal to the metal? Do they ease up? Do they touch the brake? Do they deploy a parachute? Does the dragster stay on the track? Never before in the history of the world has a central bank been able to orchestrate a soft landing to a market that has been financially engineered, especially the likes of this one. This is where the game is being played out. Tomorrow, of all the Fed meetings that we just totally ignore, it's probably a pretty important meeting. I don't think they're going to raise rates. That would be certainly like hitting the brake, and I think cause some issues. But their wording and their actions, they could be, I'm not saying they are, they could be in a box. They could be in a box. If they say nothing, then these rates will go negative, and this dragster is going to race down, keep racing, faster and faster and faster, until something breaks. Or they try to ease up. There is a the biggest short position is on 30-year treasuries. So as the rates have risen, the 30-year treasury has gone down. That has been a successful trade. If that market and those shorts think that the rates have peaked here, the Fed's not going to let them rise any further, they will do what? They will buy their shorts to cover, and they'll push these rates down, and these rates will rise up. So we're expecting, in a very short period of time, we think there could be a significant spike in volatility, and we think that the markets are poised for a sharp pullback at minimum, because they haven't priced any of this in. And the people who are buying GameStop, the people that are buying the NFTs and Bitcoin and everything, are not really privy to this view, and they're not really paying attention to where the real game is being played. So I'm bagging on at stockmarketcaddy.com. We are algorithmic traders. We trade primarily intraday, but occasionally we will come in and get ourselves in position for a shift in the markets, and we do think a shift is coming. I understand, and our systems are picking up on the trends, and we understand the trend has been up, but every trend change does start with a counter trend move, and we think that move is near at hand, one way or the other. We do think so, and we think it's going to be a story about here. And so it'll be probably another month from now that you'll be hearing and reading about that on CNBC. If you like this sort of thing, feel free to give me a call. Feel free to visit our website. I'm Bag It On, 813-758-8263. Thanks.